Right. Welcome, everyone, and thank you so much for joining us today. My name is Nadine Bayer. Some of you might know me already because I'm the Academy Manager at Accounting for Sustainability, and I'm really excited to welcome you to today's webinar on Lead the Way, Managing Future Uncertainty. Please note, you might have already realized when you were joining us, this webinar is recorded for others to review, so it will be made available on our A4S YouTube channel and on our website as on-demand webinar. So just for you to be aware of. These monthly Sustainability in Action webinars are part of the wider A4S Academy, which I know many of you are currently participating in. And the Academy is a program designed to empower and equip senior finance professionals with the skills needed for their businesses to succeed in the face of environmental and social risk and opportunities, and to manage future uncertainty, which we hear more about today. These webinars are open to Academy and non-Academy participants. All are welcome, and it's certainly learning experiences. In terms of what we're covering today, we are very excited to have two panel speakers today, one from Levi Strauss and one from Manulife. And after the panel discussion, we have plenty of time for you to ask all your questions and to really learn more about what our panel members have been doing regarding managing future uncertainty and everything you've heard about. Then we will go through some theory to really manifest everything we've heard, and we will introduce you to the A4S content on managing future uncertainty before we're wrapping everything up and letting you go back into the world. In addition to the Q&A time later, you can of course ask any questions you have freely in the chat function throughout the whole webinar, and we either address them directly or we address them during the Q&A time. Throughout today's webinar, we will also running some polls. This really allows you to interact with us and to share your input. But also, if you would like to earn any CPE or CPD points for attending today's webinars, please ensure that you respond to all of these polls, as this is prerequisite for you to earn your credits. In terms of the learning objectives for today, we really hope you will be able to articulate the business case for responding to macro sustainability trends, understand approaches for integrating sustainability into risk management and decision-making frameworks, list practical methods and techniques for identifying risks and opportunities, and identify ways to further your organization's approach to integrating sustainability within enterprise risk management. And while this all seems a lot, after the session, it hopefully will all make more sense. And I'm really, really pleased to introduce you to today's speakers. So we have with us Julia Reuter, Director for Sustainability Accounting at Manulife, and Pavan Murray, Senior Vice President for Finance Operations and Sourcing at Levi Strauss & Co. You will also be hearing from the A4S team, of course. So with us today is Brad Sparks, Director of the US chapter of the A4S CFO Leadership Network, and Elizabeth Toe, Senior Manager for Sustainability in Accounting, and myself. So before we get started and before we really dive in, we obviously want to find out more about you. So we will run a few poll questions now. So we would really like to know, which department are you from? And to what extent does your organization currently integrate sustainability into risk management and decision-making frameworks? And in your role, to what extent can you support your organization in responding to macro sustainability trends? Interestingly, which is good news, you think that already to a large extent or to a moderate extent, your organization currently integrates sustainability into risk management and decision-making frameworks. And you have already realized that the extent to which you in yourself can support the organization responding to macro sustainability trends. So that is already great news. And hopefully after today's session, you even have more of an understanding of how you can influence and support your organization. All right. So then I would say, without further ado, Brad, I hand this over to you.
Great. Thanks so much, Nadine, and welcome everyone to today's webinar. So before we get started with the interview, let me first kind of open by setting the scene and talking about a little bit about what it really means to manage future uncertainty. What are we talking about when we use those terms? And what we're really looking at is how do you evolve the business processes that you have today that are make them able to respond to some macro sustainability trends that are impacting the global economic system. So those trends may be things like climate change, maybe livelihood crises, as we've seen from the pandemic, and maybe biodiversity loss or income inequalities. And as organizations think about how to respond to those, they should recognize that there are both risks that are important to them as an organization, but also opportunities for business in being able to address those. And that gets to the concept of how do you go about managing this? That's difficult because a lot of the things around these uncertainties and these trends are really hard to predict by the nature of what they are. So many have long-term horizons, many have unknown scale and timing of impacts. Many have maybe a lack of clarity about what future public policies or regulations may be relevant and may impact the process that gets followed. And then many may also be susceptible to shifting customer and consumer preferences. So if we think about, again, something like climate change, it may be that it's hard to do because one, it's going to be over a lengthy time span, but we actually don't know when some of the most severe impacts will happen. If we look at disclosure and regulations, we see suddenly a lot of interest from regulatory bodies in enabling and promoting and requiring climate change related disclosures that weren't there just a few years ago. So these things can happen very rapidly, and it's hard to really be able to predict and understand what the rapidness of that may be. Another one of these issues that makes it challenging is that really understanding the benefits from addressing sustainability trends is harder to measure and quantify than what you would do with traditional risks. So it's a challenging issue to understand how to best navigate. But luckily today we have two great leaders in this space that can help us understand the approaches that they're taking. And we're very pleased to have, again, Julia from Manulife and Pavan from Levi's to help talk about exactly what they're doing to future-proof the financial decision-making process that they go through, and by understanding, measuring, and incorporating social and environmental risk and opportunities. So again, welcome, Julia, Pavan. Thank you so much for joining us today. So to get started, maybe Julia, if we can start with you. First, give us a little bit about your role and your involvement in ESG integration into risk management at Manulife.
Sure. Thank you, Brad. I am quite fortunate to have the role that I have, which was created by our Chief Financial Officer back in 2017 as part of his commitment to A4S and as part of him becoming the first inaugural co-chair of the Canadian CFO Leadership Network with A4S. So my role was created to do exactly that, to help our CFO drive the integration of environmental and social risk management into our decision making. And I must say, before we even got to risk management, we had to set up a number of governance structures that involved senior executives to even enable some of this integration. So we immediately recognized on the finance team that we can't do it alone. It will need to be a collaborative effort. And the first couple of months of my job was really making a number of PowerPoint presentations to take it to our chief risk officer, chief investment officer, a couple of other chief officers on our executive management team to get them to come together somewhat informally in the beginning. And then as we formalized our structures, actually form what we now have as an executive sustainability committee, which is supported by the Center of Expertise that we created on sustainability, where finance also played a very important part. and all these structures are now report into our board. So I would say the first role of finance in this journey for us was really to convince and influence other executives, other colleagues across the company to come together to set up governance structures before we can start driving any changes to our processes.
Perfect. So, and I know collaboration and governance is key, and I know, Pavan, you've worked through that at Levi's. I wonder if you could share a little bit about how your journey's gone and the start of your own process of looking at these macro sustainability trends.
Great. Thank you, Brad, and thank you for having me. I want to say right at the beginning, I know that this is a group of finance professionals who in the poll have talked about how you're already incorporating these elements into your work. So I don't stand here as an expert that is teaching people who don't know what it is, but more as someone who wants to share what we have done and learn from the audience as well through the questions. Having said that, at Levi's, my role is as the finance lead for our operations team. So I'm basically the FP&A guy who supports our COO, and our sustainability team reports into the COO. So I provide finance support to the sustainability team, and I also look after our shared services. So that's where I come at this from. And at Levi's, we like to say that sustainability is woven into everything that we do. So we have a pretty long and illustrious history of environmental leadership and social leadership. So in 2018, we announced our science-based targets on climate, for example. And when we did that, we were the first company in the apparel industry to sign up for targets that are in line with limiting global temperature rise to 1.5 degrees Celsius. And now several other companies have followed suit, and we are really excited about doing this work now.
Great, fantastic. So I guess as you think about these issues of social and environmental concern, how do you go about kind of understanding what are the key issues? Maybe Pavan, if we start with you, I'd love to ask you as well, Yulia, the same question, but Pavan first.
Okay.
So the way we look at these issues is in the context of our holistic enterprise risk management framework. And we have a cross-functional team that includes finance, sustainability, operations, legal, and a number of other groups as well. And our biggest asset is our brand. And for our brand to do well, we need to do the right thing, both from a social and environmental perspective. And apart from the issue of the brand and making sure that we are doing the right thing there is also a lot of investor interest in ESG issues that we also are responding to, and we are seeing heightened interest in that space as well. And with those as the drivers, we have integrated all aspects of sustainability into our enterprise risk management framework. And that's how we assess the holistic risks facing the company with risks related to sustainability in that overall frame.
Great, and we definitely want to get into a little bit about that and the how you actually do that in a few minutes. Maybe, Yulia, before I go to you for a similar question on identification, I'd also like to just let everyone in the audience know that we encourage any questions through the chat feature of the webinar. So please submit your questions and we'll try to address those through the conversation. So Yulia, back to you then. In terms of identification of ESG risk and opportunities, can you share a little bit about your approach at Manulife?
Sure. I would say I would like to resonate the Pavan too. I would say initially, as we first started, we've had a more holistic approach to it. run a number of natural resource businesses as Manulife. We used to have an oil and gas operating subsidiary, which we sold last year, but we also run a timberland and agriculture business. So within those particular businesses, we have always paid attention to environmental and social risks. But to Pavan's point about a broader risk management framework that also includes the rest of our business, because we have many more assets under management and in our insurance underwriting business, that was a bit of a journey. And the way we've done it is we've really used the feedback from our investors. It was a bit reactionary at first, but we really spoke to investors to better understand what's on their agenda. We've also taken a close look at the ESG evaluations by the credit rating agencies and ESG rating agencies. So I would describe our approach to get to, plugging these risks into the enterprise risk management process is by looking at how others evaluate us. And when we first started, credit rating agencies didn't have very specific and robust frameworks, and this sat more in the domain of the ESG rating agencies. But if you pick it up nowadays, there are plenty, your key flagship rating agencies all have ESG evaluations. So you can really pull up their assessments and look at how they rate not just your business, but also what types of risks they see for the entire industry or entire geographies. So I would say this would be a useful place to start as you look to beef up your enterprise risk management to incorporate risks such as human capital, climate change, and others.
Great. And I know just on that point, and we're getting a few questions in the chat. There's interest in when you look at kind of the various ESG indices and other kind of areas where you're getting questions from investors and other stakeholders, and being able to respond appropriately and giving them the right information that your organization is able to efficiently and effectively capture. I don't know, Pavan, is there anything as you think about that process that you've done at Levi's that may be useful to share?
Sure. I think I'll probably focus on a couple of examples just to make it a little more tangible. So for us, as we think about the risks related in particular to climate change, so we think about the supply chain. So most of our products are made with cotton as our biggest input. And cotton is cultivated with a lot of water, and basically China, India, Pakistan together account for the majority of the world's cotton output. And most cotton cultivation is dependent on rainfall that is influenced by changing climate. And we look at scenarios for what will happen over the long term to world cotton output. What will that do to prices, and what will that do to our cost of goods sold? It's a real business issue for us from that perspective. Another example would be the way we actually source our products from around the world. So we rely on garment factories in many developing countries around the world, like Bangladesh, Pakistan, Cambodia. And the interesting thing about all of these countries is there is exposure to extreme weather events that are again made worse by potential climate change related weather patterns. So we look at, when we think about our very operational decisions, like how to plan for production for the next season, which products to make where, we need to think about how, if there is a potential severe weather event that knocks out a cyclone in Bangladesh that knocks out production capacity there for a while, what's our plan B? And ensuring that in our global network of suppliers, we have sufficient diversification for that. And as these events become more severe over time, we would need to have more backup plans for all these eventualities. So just a couple of examples of how we need to think through. And the last one I'll also share is thinking about as climate change changes weather patterns, how consumer preferences would change. And we make very high quality, durable products, and we are in competition from a consumer perspective with potentially shorter lifespan, fast fashion items. And our focus is on basically buying better, higher quality products and wearing them longer, which we think is actually beneficial for us from that perspective.
Yeah, perfect. And thank you, those. I think that really clarifies and crystallizes the exact way that ESG issues impact your overall risk management and strategy. I wonder, Yulia, I know you mentioned a little bit about having different nature-based products within your investment portfolio, but if we talk about climate change in particular, could you also give kind of a similar level of detail of how climate change specifically can impact either your investment portfolio or the product and services that Manulife offers?
Sure. We have done a number of evaluations. We see the impacts of climate change threefold for Manulife, and we're a financial institution that writes life and health insurance. We provide reinsurance, and we have wealth and asset management services. So we think of it as threefold. One is climate change impacting our operations, either impacting people commuting to the offices or buildings. But also operations, as I mentioned, we have timber business. So that's one bucket of it. The other one, product risk management team has looked through a number of academic and actuarial research on climate change to see what type of health impacts we as an insurance company will increasingly need to underwrite in the future, and which ones and in which jurisdiction they would be most prevalent. And then the third bucket of where we see our exposure lies is in our investments. And we have the asset, we're the asset owner, where we manage the assets that underline our insurance liabilities. But then we also have third-party management business where we invest on behalf of our clients. So those two groups have been quite active over the past couple of years in getting a handle on a number of scenarios, climate scenarios out there. And in the case of our third-party business, looking at some of the scenario analysis on the on the asset owner side, looking at it more from the stress testing standpoint to see whether our capital adequacy can in any way be affected in any of these climate scenarios. So those would be just some examples of the work that we've conducted. And the stress testing part has been led out of the finance. This is where the capital management team that reports into our CFO has been quite active to help business understand the impacts.
Right. And I mean, I think that gets to then kind of understanding what the drivers of some of this is, right? To help the business understand the impacts and the opportunities. But Pavan, maybe just to again kind of crystallize, what would you identify as the top three drivers for integrating sustainability or ESG factors into risk management?
Yeah, I think for us, first, I think it is the right thing to do when you're trying to have a comprehensive view of the risks. Like I mentioned, both on the supply side and on the demand side, there is a lot of risks and opportunities that are very business relevant that we need to factor in. The other thing that I would also call out is given the questions and the nature of the questions that we are addressing from external parties, whether that is investors or analysts or even third parties that are observing the space, it is important to have our overall view of risk management incorporate these risks so that we are providing consistent information back to all external parties so that the way we are driving decisions is what we are using and sharing instead of being a very reactive approach to external inquiries around these matters.
Great. Great, and we are, thank you everyone for the questions in the chat, and we'll try to incorporate these throughout the conversation. Yulia, one that we are seeing is really around, related to the business benefits that have been realized or lessons learned in your approach. In particular, there's a question around, have you been able to identify the ability to either understand how to lower the financing cost of a company or really understand impacts on a company value by thinking more holistically around ESG and sustainability issues? Anything you can share around the benefits?
Brad, I'll have to ask you again. I'm not quite understanding the question.
Yeah, so the business benefits that you've realized from the approach of integrating ESG within risk management, and in particular,
right,
are there benefits related to company value in your investments?
Good question. Company value, very tough, but let me answer the previous one. In terms of the benefits for the business, we've definitely seen the benefit. So we have 3 key stakeholders at Manulife that naturally we have our clients, we have our people as our biggest asset, and we also have to deliver shareholder value to our shareholders. So in terms of the value to our customers, the focus on climate change has really helped us on the asset management business, where we were able to bring a number of new and innovative products to market. We have a product for institutional investors. We issued a green bond at the Manulife level, but our asset management business has also been able to create a number of innovative equity and bond funds tilted for sustainability and climate change. So that's one benefit. The other benefit came more intangibly in the form of a better employee engagement. Just this past month in May, we announced that we are finally committing to net zero way out in the future in 2050, so a long shot, but we've also committed to make this long-term commitment more tangible in the shorter term. So we committed to science-based target, somewhat later than Pavan back in 2018, but better late than never. So we have committed to the science-based targets, and we've also committed to creating a plan within a year and setting the targets for the most carbon-intensive portions of our portfolio, which will include power generation, utilities. And I think it's been really engaging for our own people. We've had a lot of great feedback internally in the organization that they were, they're proud to work for the business that wants to do good for the environment. And then finally, in terms of the benefits, we've also seen the rise in our ratings, in our ESG evaluation ratings, which has really been helpful in our investor engagement.
Great, thank you. Great to hear. Let's take a moment now for a quick poll question. James, if you'll put up the poll, just again for CPE and CPD credit, you should see a poll question coming up now on your screen. We're able to launch that. Oh, perfect. So this one is around the business case for responding to macro sustainability trends. Which are the right responses there? You can select more than one. So gaining deeper insights, managing stakeholder expectations, regulatory response, business reputation management, and creativity and business opportunities. All right, we'll just give it a few more seconds to let you all answer those poll questions. All right, it looks like the leading ones are around stakeholder engagement and expectation management and business reputation. So thank you for responding to that question. And I wonder, Now, Pavan and Yulia, it'd be good to get into some of the details of the how. So as you think about the approaches you're both taking, getting really into these specifics of the how, I think is always useful to the audience. And so maybe we could start with really a focus on climate change and sharing in a little bit more detail your approach, Yulia, first, in understanding and assessing the impact of climate change, specifically techniques, methods used, the role of finance, and how you collaborate with others.
Do you want me to go first?
Yep, please. Yep.
Okay, so in terms of practical tips and tools that we used, what was really helpful for us is that our CFO has signed the letter of support for the TCFD back in 2019 as part of A4S. And this is where, it was really helpful for us to get through that guidance to really figure out what we need to be focusing on over the next several years. And what we read in the TCFD guidance was that we needed to have good governance structures, risk management controls in place. There was an element of disclosure there on scenario analysis. And we also read that the metrics would ask for the carbon profile of our investment portfolio. So our plan for the TCFD implementation, including tackling these two items after we've set up the governance and after we've written our enterprise risk management policy and ensured that those risks were embedded. So in the scenario analysis, when we started, there was a lot of uncertainty around those scenarios. Things are in much better shape now. When we started, there was no Bank of England Prudential Regulatory Authorities stress test, and none of the major risk system providers had it embedded. So we were really experimenting at that time. So I must say there's definitely less uncertainty around these tools now. And I would definitely encourage anyone on this call looking into climate scenarios to look at the Bank of England's ones. And then the other key role that we think finance played in helping the business assess these exposures is to really taking the lead on quantification of our carbon emissions in our invested assets. And this is where finance really came in with an expertise on accounting controls. We've interpreted the greenhouse guidance. We looked at the Partnership for Carbon Accounting financials, which has recently, just in October 2020, released the guidance for financial institutions. And so we felt that finance can really leverage, the skills, things that we're good at, measuring things, quantifying, to really help the sustainability team and the business overall with the quantification.
Perfect. And it's such a critical skill set to leverage and utilize when you're thinking about the management of something like greenhouse gas emissions or other ESG data. But Pavan, could you share a little bit about your approach at Levi's?
Sure. I think I like to think of it along two dimensions, basically around time horizon. So one is the long-term time horizon scenario modeling, like Yulia was talking about. So really understanding what the world looks like at 2 degrees Celsius temperature rise versus even worse, and what does it mean for every aspect of our business, starting with, let's say, consumer preferences. Will we all want to wear fundamentally different types of apparel in a world that is warmer, which is presumably right, that is going to happen? And what does that mean for the business that we are in? All the way down to, are we going to be making denim with fibers like hemp instead of cotton because of how water intensive cotton is and what I've referenced earlier? So finance has a very big role to play in this long-term scenario planning. So I partner with our head of sustainability for the enterprise risk committee, creating the scenario options or models and how we start thinking through it. So we just started that work. Then on the more immediate time horizon or shorter term time horizon, we are focused on a few things. One is what I mentioned about the operational production decisions. So I won't go back to that. I mentioned how we think about that. We also have, for the science-based targets that we have in place right now, our emissions, when we look at our total greenhouse gas emissions, just 1% of our total value chain emissions originate at our facilities, owned and operated facilities. 2/3 of our emissions happen upstream, all the way from when the cotton is cultivated to the garment factories. And those are facilities that we don't control. And then the remaining 1/3 occurs after sale of the product. So it's in the life cycle of the product that we sell to our consumers, whether it is laundry or other energy intensive steps. So when we think about our even baselining is a challenge, because 2/3 of the emissions occur upstream, and gathering all the data from so many different suppliers, many of whom work with other brands who have slightly different needs on the data. So finance plays an important role in helping the sustainability team bring all that together. The other big thing that I am focused on is on ensuring that our suppliers have access to capital and financing to make the improvements they need to make. So the baseline is one challenge, but once you have the baseline, what are we going to do about it? How do we actually achieve our Scope 3 emissions reduction targets? And for that, the suppliers who are already very challenged because of COVID and their balance sheets are weak, how do they finance the investments they need to make in renewable energy or upgrading their fossil fuel boilers and other equipment that they have in their factories? So those are some of the elements where the finance team partners very closely with our sustainability team to put together partnerships along with Treasury, with banks and multilateral institutions, where we can provide data and they would provide the financing at relatively attractive rates to our suppliers.
Great, and that, understanding that collaboration, how it all works is, a common question in the chat that we're seeing. So thanks everyone for providing some of these questions to look a little bit deeper into those. I know, Pavan, we've got one specifically for you asking about, the amount of time you spend on what you would consider ESG versus what you consider your normal role. And it seems like those are very much blended, but any thoughts on how you split that?
I don't even think of a split. It's like any conversation can very quickly become an ESG conversation, and any ESG conversation is an operational conversation for me. I think we do have a few initiatives that are more targeted towards ESG. Like right now, this month, we are in the middle of finalizing our response for the Carbon Disclosure Project, where we report every year on our carbon emissions. And as part of that, I'm spending time on quantification and validation of the work my team has done to quantify our risks and opportunities. So probably because of when you're asking me, maybe more than 20% of my time this month has gone into that. But I would say more broadly, it's just an integral part of the job.
And then, Yulia, this builds on what Pavan was just talking about, data integrity and looking at information. I know when you talked a little bit about bringing the finance skill set of accuracy and robust data collection and measurement, there's still a lot of uncertainties in that process and estimations and understanding that. Could you go a little bit deeper into kind of how you've addressed some of the challenges of estimating and getting consistent information and on a timely basis, which is always a challenge as well?
Great question, Brad. It's not easy. There is a lot of uncertainty still around data. Some data just doesn't exist. But I would say this is not an excuse. To create a carbon profile of our investment portfolio, we collected as much data as we could. We used a third-party research provider, the subsidiary of S&P, by the name of TrueCost, to help us gather as much information from publicly traded companies that we invest in. But that still left a very wide gap of, because our investment portfolio has a very significant private component. And so we, we just had to put our finance hat on, and we had to estimate. So we ended up constructing our own methodology, which was guided by the existing greenhouse gas emission accounting frameworks. And some of them were more definitive than others. I wouldn't say that we never had questions and everything was perfectly clear. We had to go back to some of the standard setters to clarify some of the treatments. But overall, I would say, I think finance professionals deal with some amount of ambiguity in their daily jobs anyway. We are in the business of forecasting, and we have to estimate. Inventories are often an estimate to begin with. So I wouldn't be discouraged by either lack of information or incompleteness of it or inconsistency. A lot of data is very dated. And for example, if we're still looking at the 2019 greenhouse gas emission data for our analysis, because at a point there's a big time lag between your analysis and when the data actually comes in. But don't be discouraged. You need to start somewhere. It's there. If there is no precise data, you can probably come up with a reasonable estimate using industry averages.
Yeah, I think that's a common concern initially by finance leaders in this space is, wow, how do I go about estimating something? And then when you think about it, right, accountants are estimating things all the time. So it's how do you bring about some consistency in that process that's really key. Again, thank you all for some great questions in here. So I do want to make sure we're covering many of them. One that's interesting to me that's been raised is, how do you differentiate between business resiliency, right? So disaster recovery plans, impact of severe weather, and sustainability, right? Is there a distinction between how you think about business resiliency versus managing ESG and sustainability risk, or is it all kind of combined together in your approach? And if either one of you have an example there, I think one thing I sometimes run into is, people will have a specific team devoted to business recovery, right? And that may be separate from the sustainability and the finance support of sustainability teams. So love to hear your thoughts on that.
I can jump in on that one. For us, it's when we think about disaster recovery, it is a distinct element where we think about how do we come back from a severe weather event or a major short-term disruption that basically keeps us down in a particular location or area for a little while. Like, that's the focus of that exercise. And that's driven by our security team working in partnership with many other teams around the company. However, when we think about our overall enterprise risk management, the enterprise risk committee has the security team there. It's part and parcel of the overall set of risks that we are looking at. And the connection that I see with sustainability is that there are elements of sustainability like climate change that make it that much more important to have a robust disaster recovery or business resilience plan because of the increased frequency and severity of weather events and things like that. So I think you need to have a very good business resilience program, which then gets tapped into more and more, unfortunately, as a result of worsening climate change.
Great. Yulia, anything to add on that?
You know what, my example is a little bit more far off, I think, so I think it would be better to leave it with Colin. Yeah.
Hey, one other question that I'm seeing from a few of the people in the audience is, when you think about the linkage specifically of sustainability issues to the risk register, and maybe the risk register of a specific region, a division, a group, depending on your organization structure, how can you share any information about maybe how you've assigned ESG risk to different risk registers within the organization, and how that may be utilized to influence decision-making in that group or region?
I can go first. I think before we stood up the Enterprise Risk Committee, I think it was last year or the year before. Prior to that, we had our internal audit team who would basically own the enterprise risk register and work with leaders from across all the different functions to assign probability and impact and really identify what are the top risks for the enterprise. And then obviously keep the audit committee of the board up to date on the risks and the mitigations. In that approach, we were basically using all sustainability related risks in the same register. And with the Enterprise Risk Committee, it's just a more formalized way to engage these stakeholders more frequently instead of doing it once a year, led by the internal audit team. This is a group that meets every quarter and looks at all the risks holistically. But it is, the way I think about it, it is one register that includes sustainability related risks in that register.
Yeah, great, thank you. And I think for many companies, internal audit is underutilized in their ability to really help address and manage some of these sustainability risks. So great to hear kind of that involvement from internal audit at Levi's. I think we're wrapping up on our time for this portion of the webinar, but do want to end with a closing question for both of you. Maybe we'll start with Yulia in terms of top tips. So many in this audience are looking to think about how they can further improve embedding sustainability factors into their risk management processes. Any kind of top tips that you would have to help with the conclusion? And Yulia, first to you.
Sure, I would encourage you to get on top of the TCFD disclosures. For us, it's been super helpful. We found the guidance was not prescriptive. It left a lot of some room for interpretation, but in general, it's been quite helpful to think through the mechanisms that need to be put in place on the risk management front, but also how the business may want to think about integrating climate change into strategy and what types of KPIs are there to track and the targets to set. And then another one, which also was quite interesting for us, is we on the finance team, we thought we could do a green bond. We can issue a green bond and become the first life insurance company out there to do that. So that has also really helped further the conversation as to, what's green and what's brown, what's high carbon, what's low carbon, and what is our exposure, what do we need to measure? So I would encourage you, and this idea wasn't very scientific. We just actually, it was a conversation at the bar, and we thought we might as well give it a shot and see what happens.
Perfect. So, and Pavan.
For me, I think I'll leave with two. One is sponsorship is critical. In my experience, when the CFO says this is important and must get done, that really moves things along. And I have seen my finance team and the sustainability team really respond to that challenge very well when my boss put that out there. And the second thing I'll say is, we're talking about managing future uncertainty. There is a lot of uncertainty about how we should manage future uncertainty. I think we should just get going and figure things out along the way. Don't wait for the perfect set of answers with everything figured out before you start implementation.
All right, perfect. That's a great way to end. Keep going. Yeah. All right. All right. Well, thanks so much. This was really fantastic. I think the exact level of kind of practical advice that we hope to share at A4S webinars. So thank you very much, Julia. Thank you very much, Pavan. Really appreciate your time. And I'll turn it over to Elizabeth to cover the next section.
Great, thank you, Brad, and thank you to our speakers. And as we just heard from Yulia and Pavan, I think managing future uncertainty is really critical to the long-term viability of companies. And in essence, it's about understanding, measuring, and incorporating sustainability factors into your risk management and decision-making framework. So, and it really makes clear business sense to do so as well. I think, businesses are already experiencing the effects of macro sustainability trends such as climate change. So let me just briefly introduce you to the A4S Essential Guide to Managing Future Uncertainty, which can help you with this. So in the guide, we set out the approaches that you can take to overcome the challenge of uncertainty and to better understand the associated risk affecting your business. And once the risks are identified and assessed, you can integrate them into your risk management and business decision-making processes. And although the guide was published a few years ago, the principles and the practical guidance is still very relevant. For example, under the current global pandemic, which is impacting businesses across the world, we find that businesses are working hard to respond and recover in the short term, but also adapting in order to build greater resilience in the long term. And resilience is about learning to thrive under uncertainty. So this resonates with the business case for responding to macro sustainability trends, which our speakers touched on earlier. So in the guide, we highlight 6 key advantages, which we gathered from our CFO Leadership Network members. So I think some of these, we talked about just now. By responding to longer term risk, you will increase resilience by preparing for future multiple scenarios. You can identify new business opportunities and avoid potential threats, reduce your exposure to regulatory, resource, and price risk, make better informed decisions, create an attractive proposition for your employees, and also build trust with your key stakeholders. I think overall, the key message is that anticipating and preparing for future trends and the associated risks and opportunities should be an essential part of any organization's strategy. So the guide, the A4S guide sets out 3 key steps to integrating risk into your decision making. So you can see it on the screen now. Step 1 is about identifying risk, then step 2, understanding and assessing the impact, then step 3, integrating into decision making. And in the middle, you can see we have monitor, review, and communicate, which is about establishing accountability for monitoring the risks, having periodic review to allow for new risk and emerging issues, and then procedures in place to also report on how the risks are being managed to both your internal and external stakeholders. So let me just go through each step very briefly. A lot of the points I'll cover will reflect or summarize what Yulia and Pavan shared with us earlier. So in identifying risk, we have to recognize, I think, first of all, the difference between traditional and sustainability risks. So I think macro sustainability trends will involve looking at longer term horizon. The risks are often harder to predict, harder to quantify, and you will need to involve multiple stakeholders to identify the risk, and they're often interconnected as well, affecting your business on many different dimensions. And to identify sustainability risks, actually what you can start off with is actually look at some of your existing methodologies and adapting them to help with this exercise. So they may include scenario analysis, using risk questionnaires and surveys, and also SWOT analysis and other techniques. You can refer to the A4S guide for more details. And in terms of understanding and assessing the impact, which is again quite different when working with sustainability risks. These approaches might also be very familiar to you. You may be using some of them already, for example, qualitative risk assessment, trend impact analysis, and also scenario modeling. So really encourage you to look at our guide to find out what are the benefits and challenges of using the different approaches and how to apply them in practice. And the methods and techniques have evolved quite a lot as well. So in the past few years, so we are updating some of the elements of the guide this year, and we'll be releasing a new version very soon. So in terms of integrating the risk into decision making, the A4S guide talks about the enabling factors that will assist you in integrating sustainability into your risk management. And some of our other guides will then expand on how that's done in practice. For example, integrating sustainability into strategic planning and budgeting, management information, your capital investment, and also engaging with investors as well. And as with all our guides, there's a maturity map for managing future uncertainty to help you assess where what you're currently doing in response to uncertainty and how you can advance to a leading position. So the links to the guide and also the maturity maps and other resources will be sent to you in a follow-up email afterwards. So just to close this session, there's a quick poll question for you. So what are the key steps proposed by the A4S guide to integrating macro sustainability trends into decision making? Yeah, so the second one is the correct answer. So identify risk, understand and assess the impact, and then integrate into decision making. So thank you for that. I will now pass over to Nadine just to give us some notices to end.
Thank you, Elizabeth, and thank you so much, Brad, Julia, and Pavan. That was really insightful, and I know we've almost overrun, but I'm sure everybody agrees that this was so interesting. There was no way that we're gonna cut anyone today short. So as Elizabeth was mentioning today, so all the information such as the guide, the maturity map, and any other really interesting and relevant resources around managing future uncertainty will be sent to you via email afterwards. So please watch out for that one. And today, as you've heard, Julia and Pavan gave us some really great practical examples on what incorporating sustainability into risk management can look like and how to adapt existing processes. So obviously, all the knowledge doesn't help us if we don't translate it into action. So we really want to hear from you now. How will you translate what you've learned today in this webinar to your work in the next 6 months? There should be a poll on your screens now. And please let us know all, what will you do in practice? Will you apply different methods to identify sustainability risks? Will you maybe work with the risk and sustainability teams? Will you engage your CFO? Will you communicate and report relevant sustainability risks, identify opportunities, or will you use all the A4S resources on this topic that we will share with you later via email? Fantastic. Actually, the majority of you will use the A4S resources on this topic, which obviously makes me really happy to hear. But just as much, are you also planning on engaging internally with your teams and your CFO to work more on this? And I'm sorry that for some of you the quiz is not appearing, but obviously if you want to share with us in the chat how you will translate today's learnings into action, please feel free to do so. While the poll is running, just to let you know, so as I've mentioned at the beginning, this is these Sustainability in Action webinars are part of a monthly series that we're holding. And each month we're exploring different topics linked to the A4S Essential Guide series that Elizabeth mentioned earlier. And the next one in July, we will be looking at how to transform your decisions, and looking at strategic planning, budgeting, and forecasting. Once again, it will be really interesting sessions. We will have several panel speakers there, and we really hope to see you there as well. And if you're somewhere in the world where you are the times at which we hold our next webinar is not suitable to you, don't you worry. So as I mentioned at the beginning, each of our webinars are recorded and they're made available as on-demand webinars on our website for you to review. So the learning objective is still there, and you can still get all the insights from our speakers, even though you won't be able to participate live. And before we draw into a close, we obviously would really like to know how you find today's session. According to all the questions you've asked, I think you really enjoyed this, but obviously we would like to have the numbers. So before you're all wrapping up, it would be really great to hear how you found today's session. And once again, Julian Pavan, thank you so much for providing us with all the insights today and sharing with us how you and your company is managing future uncertainty. And to each and every one of you who participated today, thank you so much and for all your questions. And I really hope we see you at the next session.